The most profitable fund in the world runs not on intuition and not on inside tips. The Medallion Fund, 30 years, 66% a year before fees. And even after its hefty fees, investors still kept 39% a year. It doesn't hire traders. It hires mathematicians, physicists, and computer scientists. Today, we open up the 6 strategy schools of the world's top quant hedge funds. And you'll see, they are not gambling. They are harvesting the patterns of the market with science. School number 1, short-term statistical arbitrage. Its champion Renaissance Technologies and its legendary Medallion Fund. The core idea can be explained with a single coin. Imagine a coin that lands heads 51% of the time. Flip it once, and it's luck. Flip it 1,000,000 times, skimming a tiny edge on each flip, and it becomes a money-printing machine. That is what Medallion does, on timescales of minutes to days. It finds these faint deviations in oceans of data, a price sitting slightly above, or slightly below, where it should be. A single signal is almost too weak to see. But the system trades thousands of times a day, and a tiny edge, compounded, becomes an astonishing return. It uses tools like hidden Markov models to uncover the nonlinear relationships hiding between asset prices, like reading the shape of clouds to predict tomorrow's weather. The whole process is fully automated. The system finds the patterns and places the trades itself, with barely any human intervention. And it is obsessively cost-sensitive, hiding its own intentions inside the market's noise. D.E. Shaw made its name on pairs trading in the early days, and Citadel's market-making business runs on the same bloodline. School number 2, systematic global macro. The champion Bridgewater. Yes, Ray Dalio's Bridgewater. Start with a question. How many kinds of weather does an economy have? Bridgewater's answer: full. Growth rising above expectations, growth falling short, inflation above expectations, and inflation below expectations. Just as you pack clothes for 4 seasons, the all-weather strategy holds an asset that performs well in each of the 4 economic weathers. When growth booms, stocks rise. When inflation runs hot, commodities rise. When recession arrives, bonds rise. Balance the positions like ballast in a ship's hull, and no matter which weather arrives, the ship does not capsize. That is risk parity. Its pure alpha strategy goes further. It takes the principles Dalio wrote down over decades and turns them, line by line, into code. About 30 indicators define the state of the market, and then the system, not a human, sets direction and sizing across roughly 150 markets: stocks, bonds, currencies, and commodities. And notice, this is not data mining. This is causal logic, written into a machine. School number 3, the multi-factor academics. The champion, AQR Capital. If Bridgewater turns its founder's intuition into code, AQR turns academic papers into products. Over decades, academia has verified a handful of long-lasting risk premia. Value cheap stocks beat expensive ones over time. Momentum, what went up keeps rising for a while. Quality, good companies tend to stay good. And low volatility, boring stocks deliver surprisingly decent returns. These factors are like nutrients for the human body. Taken alone, the effect is modest. Blended into a scientific formula, they work. AQR systematically packs these factors into portfolios. And it doesn't just go long through long-short pairing. It distills the pure factor return out of the market's ups and downs. Then it exports the same logic, proven in stock markets, to bonds, currencies, and commodities. Its founders have all published top-tier papers, which is why a QR is called the practical workshop of academic quant. School number 4, Machine Learning plus Alternative Data. The champion, 2 Sigma. Here's a question. If you want to know whether a retailer had a good quarter, do you wait for the earnings report? 2 Sigma doesn't wait. It reads satellite images. Are there more cars in the parking lot, or fewer? It reads credit card transactions. What is real consumption doing right now? It parses social media sentiment and digests oceans of news text. The goal is singular. See the fundamentals change before the traditional data is ever published. And processing this data is not analysts, it's machine learning models. Its library may hold tens of thousands of independent models. Each one spots a faint pattern, and in the end they vote like a jury. D.E. Shaw uses machine learning to read text. Mangroup's Al applies deep learning to trend following. The key word of this school, data is the new oil. School number 5, Volatility and Derivatives Arbitrage, the most mathematical school of all. Start with options. An option is essentially an insurance policy. You pay a premium for a promise. If things go wrong, we pay you. And anything that is insurance has a pricing problem. When the market panics today, premiums get expensive. When it turns optimistic tomorrow, premiums get cheap. A quant model can compute what this insurance should be worth. When the volatility implied by the market runs higher than the volatility that actually materializes, you sell the insurance. When it's lower, you buy. Then a delta-neutral book locks away the directional risk. What you earn is the spread between panic and calm. Then, convertible bonds. A convertible is a bond plus a stock option. The model prices the parts. The pieces are worth 100. The package sells for 98. Buy the package. Short the stock to hedge, wait for prices to converge, and pocket the $2. D.E. Shaw and Citadel have been plowing this field for decades. School number 6, Quantamental and Event-Driven. A traditional fundamental analyst, how many annual reports can one person read deeply in a year? A few dozen. A computer applies the same logic, read the filings. Compute valuations, flag the problems, across thousands of companies in the entire market. Then systematically builds long-short portfolios. Cubist, the quant arm of Point72, is a leader here. Another game is merger arbitrage. When company A announces it will buy company B, B's stock jumps at once, but a small discount always remains, because the deal might fall apart. The model estimates, what is the probability this marriage actually happens? Multiply the probability by the payoff to get an expected value, then spread the bets across dozens of deals. One deal is a gamble. 100 deals is statistics. After touring the 6 schools, you'll notice, the real moat is no longer the strategy itself. It's 4 arms races. The race for data, oceans of alternative data. The race for talent, the best mathematical scientists. The race for technology, hardware and networks that compress latency to microseconds. And the race for risk control, real-time, multidimensional risk models. Plus 1 iron rule. Absolute secrecy. Core signals live inside a black box, so the strategy can't be copied. So what do top quant funds actually get paid for? Not for predicting the future, but for turning the discovery. Validation, and execution of patterns into a scientific system. Markets will always change, but the scientific method keeps working. That is the essence of quant investing.